Floods in Queensland prompting much talk when it comes to the direction of interest rates, whether or not the Reserve Bank may in fact have to lower them to help make up for what's being tipped by one prominent Reserve Bank member as a 1% hit to GDP. That translates into roughly $13 billion sliced out of the economy. Let's get the very latest with FIIG Managing Director for Money Markets, Bill Keogh, standing by at the FIIG camera in Sydney. Warm welcome to you. You know, how are you sizing it up? And to that end, is this going to be sort of game on once again when it comes to the war for deposits?
Well, look, I think that deposits are always on the agenda, and they have been since the height of the GFC. When we look at the value of term deposits, you've really got to look at the value of them and what you value the deposits to under the underlining. The underlying is really the bank bill yields. So when we talk about term deposits, we talk about the spread above the bank bill yields. It really got up to a high of over 1%, up to 1.5% above your bank bills in middle of last year. If you take the 1 year as a benchmark, we've seen a little bit of movement. Certainly the spreads have come in, so the term deposits aren't as good value, but they are still reasonable value. So you're still looking 90 basis points above the 1 year for retail deposits. Certainly if you shop around, you can probably get a little bit more.
How does that change the further out you go, so beyond 1 year, say into the 3-year horizon?
Yeah, sure, Carson. Look, the banks, or the ADIs, the approved deposit institutions, they like longer dated funds, so naturally they will pay up for deposits beyond 1-2 years. You still have 5-year part of the curve as very good value, looking up to 7% really and above. In some circumstances, depending on the ADI, you can still get 7.5%. And if you're looking at the underlying swap rate, it's around sort of the low 5s, so that's a very decent pickup. But I suppose with the deposits, what you're giving up is liquidity. So for someone to invest in a term deposit for 5 years, they've really got to be sure that they don't need that liquidity over that 5-year period. Because
the penalty for breaking that is likely to be what?
Well, that's how long is a piece of string question. Yeah. Look, with every term deposit, there's an underlying product disclosure, a PDS, which people need to read. Most of the break clauses in these PDSs are very open-ended, and it really depends on what the underlying market is doing. Look, and if rates were to go up significantly, and you wanted to break a term deposit, you're probably looking at a less break cost than if rates were to go the other way.
Well, in this environment, what are the chances of that happening? Are you with certain economists who are saying that is a possibility that we could actually see a rate cut?
Well, I mean, there's been a lot of talk, obviously, in the last couple of days, what's happening in Queensland. That's very short-dated, but I think, the RBA and some of your other presenters today have sort of put that under the carpet and still looking at rate rises. I mean, from our perspective, we think the cash rate will pretty much stay the same for the foreseeable future. And then it comes down to, well, in the deposit market, banks are still looking for domestic funds, and there will still be some competition, and I can't see that changing in the short term.
You also flagged competition, admittedly, when it comes to shorter maturities, but there is a caveat on that, isn't there? You can potentially get more for your bank at the shorter end, but you've got to have that record.
Look, there's a couple of factors. Yeah, certainly the ADIs will look at the track history of a investor, and if they're looking to place their funds in a more of a short-term horizon, what they will be looking for is, are these sticky? And when I talk about stickiness, we're talking about once the funds mature, what's the probability of the client rolling? So certainly there's that aspect. The other aspect is that from time to time we see banks wanting to fill certain maturity buckets, and this might be in the shorter dated 3-4 month area. It all depends about the underlying financial institution.
Well, before I leave you, I just must ask, how is your Brisbane office faring?
Thanks for asking, Carson. I actually flew down this morning from Brisbane. It was a little bit surreal because out of the airport there was a few puddles and there was a blue sky. And I think our Premier or the Queensland Premier was talking about that early on this morning. Unfortunately, the CBD's the power's essentially been turned off, and I suppose we're lucky because we have offices in Melbourne and Sydney. But yeah, look, the Indian is definitely struggling in Brisbane over the next few days and probably for the remainder of the week.
We wish you and your family, of course, all the very best from us here. And yeah, take good care.
Yeah, I appreciate that, Carson. Thank you.
Thank you so much. Bill Keogh there from FIIG Securities.